Hello and welcome to your midweek edition of Charting the Markets. My name is Richard Snow. I'm from Daily FX, and we're going to go over some of the important chart layouts for today, particularly considering some of the news we've already got this week. I think when looking at the charts in general, the most impactful data has been negative fundamental data, manufacturing data in particular, out of the Eurozone. And that's really just begun to weigh particularly on your European indices. We also had some news from the Bank of Japan in the early hours of the morning with committee members going to, well, I'd say the Deputy Governor of the Bank of Japan feeling it necessary to clarify that the recent changes on the yield curve were more as a result to sustain current easing policy rather than a step towards abandoning their ultra-loose monetary policy there. So we've seen a bit of a fight back in the yen, a little bit of appreciation for the yen coming through early this morning. And of course, we have the big news of Fitch Ratings Agency downgrading a US credit from AAA rating down to AA+. That not having too much of an impact at the moment. We'll obviously look at the charts and see how that plays out. So to kick things off, let's take a quick look at your dollar-yen chart just to see what the recent communication from the Bank of Japan has done for the pair. We'd obviously seen quite a strong reversal after the Bank of Japan meeting that has seen the Japanese yen more than reverse all of those prior gains. So we saw dollar yen trading significantly higher in the wake of that Bank of Japan meeting. That obviously cooling a little bit as we get that clarification from BOJ officials that yes, they're still seeing that inflation is running high. They're not entirely convinced. I think the meetings made that quite clear. They're not entirely convinced that everything that they're seeing within the inflation print has been driven by local demand side factors. It's still a bit of a balance between your cost push and demand pull influences in inflation there. So we look ahead to further forecasts for inflation. Their inflation forecast up until 2024 came in at 1.9%, so just shy of that 2% marker. So I think that's just playing into the BOJ's hands, providing them perhaps a little bit more optionality, if you like, in that they do not need to get moving straight away until such time as there's greater confidence within the committee that they will need to change their ultra-loose policy and eventually produce movement on the interest rate front. So for now, we're looking at 142.25 as the most immediate level of support. Of course, there is still a possibility that we move higher from here up to 145, the prior highs. But at the moment, we are just looking at this bit of a reprieve for the yen at the moment. Further downside, we'd obviously be looking at 138.20. That's some distance away. But again, looking at the influence of the 200 simple moving average, this red line, that gives us our trend bias. So unless we see a significant move lower from here and a break beneath that 200, the outlook still remains to the upside for now. So looking at dollar yen with great interest heading into the end of this week, where of course we are expecting a non-farm payroll data. So we expect to see quite a bit of volatility towards the end of the week in this particular currency pair. Moving across to the Australian dollar, the RBA, of course, this week opting to hold interest rates. That's not for the first time, of course. They had held previously and then realized that inflation was a lot stickier than they had anticipated, then having to hike from there on. So the committee, seeing that risks to the inflation outlook appear a lot more comfortable. What that does mean is if we aren't at peak rates for the Australian dollar, and if we are to continue to see deteriorating data in China, then the Australian dollar certainly doesn't look too good, and we've been seeing that in the last 2 days from a price action point of view. Quite tricky trading Aussie dollar around this 200 SMA. We've seen prices both oscillating above and below that key level, but for now, quite a strong rejection of a move higher at that 200 SMA, moving significantly lower, that then continuing into today's trade, where the current level of support is now at 0.6580, which is the April 2020 level. Yeah, as I mentioned, fundamentally speaking, given that Australia depends to quite a large degree on the prospects of the Chinese economy, and given that we're seeing at the start of this week, we saw manufacturing prints turn contractionary in China, which has been a long time coming. But both measures, the NBS measure and the CAIXM manufacturing measures, both dipping into contractionary conditions there. So that certainly doesn't bode well for the Australian dollar going forward. So we're watching this with interest for a potential bearish continuation, but first level of support here, 0.6580. If we're able to overcome that, then naturally our attention turns to the swing low here at the end of May, around about 0.6458. Now turning our attention to sterling through cable, pound, dollar. Now this is obviously relevant ahead of tomorrow's Bank of England rate decision. Interest rate expectations have been revised lower ever since we saw encouraging inflation data in the UK. That's not something we've been able to say at any stage during this year. So the first print where we saw core moving down quite nicely, that really has taken a lot of expectation out of the market, where previously there'd been an expectation of 6.5% where we'd see rates peaking. That's now below 5 or below 6%, around about 5.8, somewhere around there. So that's signifying markets are now anticipating a slower move in interest rate hikes and a lower peak rate being necessary in order to calm inflation. So as I said, that's just that one print that we've had so far. The jury is very much out with regards to UK inflation and whether or not disinflation has taken place and when we've essentially reached a peak in inflation. So looking ahead to tomorrow, we've seen cable moving fairly consistently lower and now testing that upward sloping trend line support, where previously we had seen bounces off this level. So potentially looking at some sort of support here. We're already seeing today price action rather undecided, seeing the emergence of what looks like a doji. Of course, we wait for the daily close, but as things stand, markets certainly looking to wait and see what is to come tomorrow. We're largely expecting a 25 basis point hike. That's down from the prior expectations of a 50 basis point hike. So we'll get further clarity there. And of course, we'll be watching what the vote split is like heading into this meeting. There may be differing views within the Monetary Policy Committee. So if that is to be the case, that is likely to indicate that we could be seeing interest rates moving in a slower fashion, perhaps opting to skip one meeting ahead and then look to possibly hike another 25 thereafter. But that's very much down the line. For the moment, we're looking at whether or not we get 25 basis points or 50, those being the consensus views, with a bias towards that 25 basis point hike. Given the recent US dollar appreciation, we would possibly be expecting prices to move lower towards 1.2676. That's of course if we do see a break below this trend line and a close, tomorrow's close, looking at a close there below trend line and potentially 1.2676. Now moving along to the indices markets, I mentioned that we've seen quite a bit of weakness across European indices. If we take a look at the Euro Stoxx 50 chart, this is something we highlighted at Daily FX yesterday. This emergence of it's not a clean evening star pattern, but nevertheless, it does indicate a potential slowing of this bullish momentum. We saw a touch of 44.93 and then intraday pullback from there, that providing the first sort of insight as to whether or not we could see a retracement of this recent bullish move. Seeing a close below this prior high, this Fibonacci level indicating the prior high on Euro Stoxx, that obviously being quite a significant level, given that we've seen prices tested multiple times in the recent past, and seeing that close below yesterday gave further conviction to a potential move lower, and indeed we are seeing European indices trading a little bit lower. Of course, your European manufacturing PMI data certainly not helping. We've had particularly bad prints out of Germany that has been leading the way for the wider continent there. So looking at immediate support at 4327, that is the prior swing high back in March. And if we are to see a close below there, well, that opens the door once again for a return to 4260, which also you can denote with multiple pivot points that have occurred not too long ago. So potentially a bearish situation here for your European stocks. Sticking with European stocks, if we take a look at the DAX, we've seen a fairly similar situation playing out, and of course quite a sizable gap to the downside this morning at the start of trade. So the DAX and Euro Stoxx, unlike US indices, we've been seeing more of a longer-term consolidation play out where, yes, of course, we've reached new highs in both indices, but we're not seeing that momentum behind these bullish moves to the same extent we've been seeing across US indices. So certainly watching this one. Once again, we see that intraday pullback after printing that new high. We then saw confirmation of that through yesterday's price action, once again trading below what we've seen here, significant levels in the past around 16,285, and now looking at a test of support just above the psychological level of 16,000 flat. Once again, still above the 200 SMA, but this could potentially be signs of a deeper pullback. It's a bit early to say, but possibly a longer term pullback given the outlook in Europe. We also have unimpressive GDP data that pretty much stagnant, although for Q2 we did get a surprise 0.3% increase there, but on the whole the economic outlook for the Eurozone not looking all that great, so tracking the potential for further bearish continuation there. Now looking at the FTSE, and this was perhaps a bit more easy to spot. This was something that had been in the works for a number of trading sessions now, where we saw price action consolidating. We see that through the very tiny candle bodies. Price is not really showing that bullish impetus. We're also not really seeing too much to the downside, apart from what we saw on the 26th, a considerable move lower, but again, a rejection of lower prices and ending the day more or less in line with price action that had been previously observed. So a period of slowdown, bullish momentum showing some fatigue, and we've now seen that move lower, which crucially we are seeing beneath the 200 SMA at the moment. So FTSE definitely one to watch today ahead of tomorrow's Bank of England decision. So keeping an eye on that for the next sort of 48 hours or so. Obviously a close below the 200 SMA would bode well for further bearish price action there. Now, if we just take a quick look at our commodities and how those have been performing, looking at gold, first of all, taking a look at a bit of a move lower. We've seen the dollar moving slightly higher. Treasury yields also seem to be moving a little bit higher. And that really just weighing on gold somewhat. We're not seeing the same sort of momentum behind bullish moves, and price action, although lower, still showing signs of a broader consolidation here. This very much dependent on how your yields are going to be trading, and of course the influence of the US dollar. A higher US dollar means gold is relatively more expensive for international purchases, and that could be weighing on gold in the near term as the dollar holds up quite well. And we're actually seeing positive fundamental data in the US that adding to a bit of dollar strength. And looking ahead to the end of this week, we get services data out of the US. We're expecting that to be quite strong. And then also your non-farm payrolls data, we're expecting around about 200,000 jobs to have been added to the economy throughout July. So while that represents a lower number, or we start seeing that trending lower, it still represents a higher print and bodes well for a tight US labor market. So looking once again, 1937 to the downside, 1985, that's where we saw resistance come into play once again. These are levels that we noticed in the prior period of consolidation where prices were moving largely sideways. But once again, gold prices fairly erratic, so very difficult to pinpoint directional moves at the moment. So playing a rather wide range here as the benchmark for bullish and bearish potential moves going forward. Now, if we take a quick look at your iron ore prices, just to make the data a little bit more legible, we'll just pop this onto a line chart. Iron ore prices are relevant considering that this is the major export from a commodity perspective out of Australia. We mentioned the particularly bearish view on Australia given the weakening fundamental data in China. So we're keeping an eye on commodities for now, particularly your iron ore heading lower. Obviously a stronger dollar adding to that to some degree, but given the rather bearish outlook on the Chinese economic front, particularly considering the lack of what the market would consider sufficient stimulus coming to play, that certainly opens a door for lower prices as far as iron ore is considered. Now, lastly, we'll switch back to the candle chart, taking a look at Brent crude oil. We've seen quite a sizable move to the upside, and a lot of that you would think has to do with the fact that supply within the market is less. As of July, we saw that additional 1 million barrel per day restriction coming from Saudi Arabia, and that has helped to see prices moving higher. We obviously need to view this in the context of a global growth slowdown, but given the fact that markets are now anticipating a soft landing in the US, well, perhaps the economic effect is not going to be as drastic as initially feared. So oil prices moving largely higher, a little bit lower today, but certainly if we are to see bullish continuation, $87 per barrel is what we'll be looking at. That would be more or less in line with the recent or April swing high, now trading above the 200 SMA. So even if we do get a pullback down to $82 a barrel, that's where we would roughly see that 200 SMA coming back into play. The door still remains open for further upside there. So quite a impressive run for oil thus far. And that about wraps it up for today. Certainly a lot to consider going forward. I wish you all the best trading. Bye-bye for now.